All right. Good evening again. Um, all right. I think we should kick start. It's almost 5 minutes past 7. All right. So today, what we're going to cover is actually lecture 6. So let me explain to you a little why we're going to cover lecture 6 instead of lecture 5. Okay. And of course, if anyone have objections, do let me know. We can go back to lecture 5. So if you, I think most of you are more or less, towards completing your GPA already, and maybe starting your ECA. So if you notice for your ECA, there's a question, or typically, not only this ECA, but for this module, generally there'll be a question on relative valuation, right? So the thing is, I was thinking rather than keeping this to lecture 6, and then you have quite little time to submit your ECA, I would like to cover lecture 6 this in lecture 5 right now. And you've noticed, of course, lecture 5 is more on technical analysis, and the technical analysis, I'm not sure if fortunately or unfortunately is not uh, tested and most semesters is like this. So, I'm thinking cover lecture 6 instead. Anyone would want to do lecture 5 instead, we can go to lecture 5 as well. Or all of you are okay to do lecture 6 today. Maybe we do a vote, 5 or 6. 6. Yes, we can go 6. Okay. Okay, we can go 6. All right. Okay, so far nobody says 5. I guess yeah. Okay, then we do 6, okay? So we do relative valuation this lecture, and then the next lecture we do lecture 5, which is on technical analysis. All right. And because also I think a few of you also have started emailing me some queries regarding relative valuation. So I thought, it's the best time to just let's tackle relative valuation, and then you can ask any questions along the way. All right. Okay, so relative valuation, we do have some theory. As you know, kind of as usual, I would like to cover some broad understanding first before we go into the details of what relative valuation is. Right? Okay, so let's just think on a high level, bird's eye view, in the simplest sense, right? What is relative valuation? Um, just a question I'd like to ask everyone. Is this the first time you heard of relative valuation, or have you heard something like this in other modules before? Before. Okay, that's I have one person that say heard before, similar first time. Okay, so there's a few first time as well. First time, okay. No worries. Okay, sounds good. We have a mixture of first time and heard before. Okay, so for those who just joined in, we are covering lecture 6 because earlier we did a poll, and I think the consensus is that we will do lecture 6 because the content is covered in your finals. So let's cover lecture 6. Okay. All right. So what's relative valuation? Right. So in simple sense, right? Before we look in all the details, the formulas, calculation, in simple sense, right? Let's relative valuation is this, and the name suggests relative and valuation. So what do? You calculate some ratios for your company, and then you just compare it with ratios of the same ratios, of course, of the industry. Right? And then you compare, okay, is this stock overvalued or undervalued? And if it's overvalued, what do you do usually? So if you compare a stock, normally if a stock is overvalued, what do you do? Do you buy it or do you sell it? You short it. That's right. So whenever it's a overvalued stock, you sell. You are right. Yes, yeah, correct. You're selling it. Okay. So this is the various essence of relative valuation. Relative meaning you are just taking the ratio of what your stock that you're interested in. compare it with the ratio of the industry. It can be a certain sector, um, or maybe you can even compare it with its peers, right? You can compare with a couple of things, right? Industry, the peers, and then you just make a judgment. Is this more than the peer or less than the peer? Or more than industry, less than industry, right? And so when we talk about peers, industry, these are called benchmarks. So we are going to compare with a benchmark, and then we just see whether a stock is overvalued, undervalued, sorry, fairly valued, undervalued, or overvalued, right? When we think about benchmark, some important considerations, of course, is that we need to consider the same sector. Like let's say we do SIA, we need to compare it with a benchmark of, let's say, airline stocks, right? It will not make too much sense to compare it with, let's say, grocery stocks like Walmart, right? So, of course, it has to be a closely matched stock. We do look at, whether the average or median of the peer group, whether it's an industry or company. Okay. Okay. So a few more details before we jump into actually doing the relative valuation. Um, some just more conceptual kind of things. And you know, right? Actually now we are like more almost towards the end of the course, and for even for this lecture it's the same thing, right? End of the day, we're giving you tools to see, to allow you to value a company, right? Remember in lecture one we were like just babies starting up this course. I always say that this whole course is about teaching you how to value a company, right? And then the thing is, we teach you tools along the way, qualitative tools, quantitative tools. We cover all the discounted cash flow type of models, residual income, and now we went to relative valuation, right? And at the same time, relative valuation is a tool. You can use it, you cannot, you can choose not to use it. Or of course, that's eventually if you are as an equity analyst, you have a choice. But if you see assessment, you notice that there is a requirement to use it because they want to test you whether you understand. So there's a requirement to use it. And the idea of relative valuation is based on this concept of law of one price, right? So the idea is that if I have SIA stocks, right, and I compare it with the peers like let's say Thai Airways, Malaysian Airways, right? The the ratios that I calculate, right, should be quite similar, right? And you'll hear this ratio, which is very common, PE ratio, price to earning ratio. So we'll cover into detail what's it, but one of the ratios that we're going to compare is price to earnings, and they should be very similar because of this idea of law of one price. So the method of comparables is most likely used to make a judgment on the price. Stock may be undervalued uh, compared to its peers, and when something is undervalued, we will buy it, and it's overvalued, we short it. So there's just a small comment here, Of course, if the peer group itself is not reflective or it's not accurate, right? Then our relative valuation, the comparison of our chosen stock with the peer group would not be accurate, right? So if everything is inaccurate, then it's not accurate at all, then this method doesn't work. Um, in the into this lecture, as we go into the details, you'll notice that relative valuation, they are kind of related to discounted cash flow, and we can relate them mathematically, and we need to relate them mathematically, right? So we'll learn how to relate them mathematically, and so will allow us to do a comparison between the peer group and the stock that you have chosen. So this will make sense in just a little bit. Okay, let's do a few more slides of kind of introduction of what relative valuation is. To do relative valuation, first we need identify comparable assets. So these can be like the peer group that we talk about. It can be an industry. Um, I think some of you also have reached out to me regarding the market intelligence tool. So I want to highlight to you that all of you should have access to Refinitiv and or S&P Capital IQ. If you don't, really encourage you to reach out to your librarian. to get access to it, right? They'll send you a code and then you just give you there's a link and then you can go in. Uh, it's particularly important for your finals because for your GBA you can rely on your group mates who already have access, right? But of course for your ECA you really need to have access by your own because you are doing the finals by your own, right? So encourage you to have the access to it because in this market intelligence tool, they actually provide you some peer and industry comparable companies. So it makes your life a lot easier, right? Compared to using Yahoo Finance, you have to calculate them individually, or maybe they provide some industry, but then without too much justification. Right? So I really encourage you to gain access to it. If you do have any problems getting access, do reach out to me. I can always reach out to the school to help you gain access. But do try to reach out to the librarian first before you reach out to me to gain access, right? Because I also have to reach out to the librarian on your behalf. Okay, so you convert them into kind of a standardized value for comparison. This makes sense. You cannot compare a super big company with a very small company, so you need to do some standardization. Compare the standardized value of this asset, control for any differences, and then at the end of the day, is to make a call on overvalue or undervalue kind of stocks. And so the thing is, for relative valuation to make sense, just note this down, on your slides, is that you should not be using one ratio, right? One ratio. You should be using, so I'll just go across here, not just one ratio. Generally, use a series of different kind of ratios and then finally draw a conclusion. Um, as as I understand, some of you all have heard this before, and maybe you have done other modules on relative valuation. So you can use other kind of relative valuation ratios, right? You are not limited to what I'm teaching in this lecture today. Okay, so there's a few more comments. We're trying to finding truly comparable companies might be difficult. So there are some issues, right? It can be quite difficult. I think a few of you also reach out to me, say that, oh, your company that you choose, they have multiple segments, right? So you need to like segment, use different betas for the segment. So yes, you are right. You need to do that. That's why, even for your ECA, I would encourage you to choose companies that are very simple, right? So listed companies, but not your big companies, like big names like Sintel or like Apple. Those are very big names. Yes, if you can do it well, it's really good. But I'll encourage you to choose smaller companies, maybe easier kind of financial statement. For example, I'm not sure any of you have heard of ASL Marine. So it's a shipping company, ASL Marine, also listed on the Singapore Stock Exchange. So anyone have heard of it or never heard of it before? No, okay. So yeah, so see, okay, some yes, one of you. Okay, so you can choose like companies like this, right? Like smaller companies, I would say they're about like bigger than SMEs, but choose those companies. So their financials are easier and not so complicated financials. One more thing, I just want to highlight is that you should always do the analysis on the group financials. I repeat again, do your analysis on group financials, not company's financial. You can just um, forget about the company financials. It's not important because normally when we do valuation, we're looking at a group basis. Okay. Okay. So going back to this, adjusting the price multiple for different fundamentals can be difficult as well. Sometimes we use market price. Actually, most of the time we have some market values that's required in relative valuation. And so, if the stock is not priced in the right way in the market, then maybe your relative valuation might not be correct. Okay, so the good thing about this module, unlike maybe if you are doing your CFA, you notice that for relative valuation in CFA, you have a lot of relative valuation ratios. But in this module, we're just going to touch on five, right? These five ratios here. And the thing is, like I mentioned, you can use other relative valuation ratios as well. If you have learned them in your other modules, feel free to use them. But we are just going to cover five. In case you have not learned the others, these five will be good enough for you to also score well, right? So do not worry if you only know five, you can use these five, and that's good enough. Okay, let's go to the first ratio, the perhaps most famous ratio called the PE ratio or price to earning ratio. Right? So in simple sense, what is this? We are first going to use the market price per share divided by earnings per share. Okay. Um, there are a lot of variation of this price to earning ratio. Okay, there are many variations. But the thing is, the idea of this ratio, let before we look at all these details, right? The idea is this, right? We want to see how the market is pricing this company based on the earnings, right? I repeat again, this purpose of ratio is to determine how the market is pricing the company based on the earnings, right? So that's a market price divided by earnings. Um, and so based on the various earnings that we use, we can determine whether it's a trailing means lagging behind, or forward, meaning going like forecasting, right? Forecasting based simply on the type of earnings that we use, right? So a trailing, which is lagging behind, will be the earnings that is in the past, right? So important thing to take note is the past is a trailing. Now, a forward kind of PE is the kind of earnings that you expect. So when you have expected earnings, this would mean that it is a forward PE. Generally, of course, forward PE is more favorable because we are having a forward-looking kind of perspective. Unfortunately, not every time you can obtain the expected earning for, let's say, the next few years. Right? Of course, if you can, then that'll be good. We can calculate the forward PE. Do you have any questions on what the idea of what is a PE before we move on? No questions? Okay. So for PE, we can compare it with historical other companies, or you can compare it with its own fundamentals. And we'll have a look at how we do it in just a little bit. Okay, so let's do some basic kind of understanding of the type of PE and the variations there are. So there are multiple variations, right? Okay, the first variation is that we want to calculate the PE based on the next 4 quarters. And in this question, your earnings is as of November 11, right? So it's November 11, 2011. And the thing is, we want to determine what is the PE based on the next 4 quarters earnings, right? And so for this case, we need to use the earnings for next 4 quarters, i.e., it means that we use the earnings for 1, 2, 3, 4. So these are the 4 earnings that we use, and these will be earnings. And for the price is 20, which is given in the question, the stock of price. So we simply take 20 divided by the earnings in the next 4 quarters. Any questions for this? Okay, I guess should be okay. All right. If you do have any questions, I encourage you to, of course, put them in a group chat or just unmute yourself. We can have a discussion on this. Okay, the next one is current fiscal. So current fiscal, since you are at November 11, so what is the current fiscal? It is this, right? The current year's 2011. So 1.1. So the thing is, if we are going to use current fiscal, this is the one we're looking at. So just look at this. So for this, we will just take 20 divided by 1.1, which is this figure here. And then we can calculate the P based on next fiscal as well. So next fiscal, we look at this, which is $2. And so take 20 divided by 2. And then the thing is, the a bit more tricky one is this one. Next next 12 months, right? So for the next 12 months, since we are at November, so we have one more month in 2011, right? So we have 2011, 1 divided by 12 times 1.1, so here. And then we have 11 more months in the next year. So we have 11 divided by 12 times 2, which is this one here. So once we determine the earnings per share for this, we can take the stock price 20 divided by 1.925. Yes, is it? Okay, so do you need to calculate them manually? No. Okay, so you do not need to calculate them manually if you use Refinitiv, which gives you the figures ready. However, just be very careful because for Refinitiv, right, sometimes the method they use to calculate PE can be very different. So please understand how they calculate. Is it trailing? Is it forward? And if it's forward trailing, how do they calculate it so that you can do the right analysis, right? Just be very careful on that. Yes, but you can just pick the figures and numbers from there, and then you put them in the table and you do your explanation. Uh, so can we state Yes, so yes, you can state whether it's forward or trailing. Um, in case you're calculating it yourself, you can do it manually. But if you're not calculating it yourself, you're picking the figures from Refinitiv, just have a look at what figures they're using and understand how they get the figures. Thanks. You know, earning is of course the primary driver of share price divided by investment value. The strength is of course is widely used by investors as well. PE is used quite commonly and it can conveniently capture the valuation in a single number, right? Because price divided by earnings, you can capture it in a single number. Yes, correct. So if you are going to take the figures from IQ or Refinitiv, yes, do state where you take it from in the references. Especially, let's say you take a table of data, right? A table of the relative valuation. You can always put a small little like a caption in the table below, say like, oh, taken from Refinitiv on this date or something like that. Yeah. So yeah, you should put some references. Weaknesses, earnings can be very small. So the thing about earnings is that it can be very small, zero or negative, right? And this is very, very, it's quite bad because let's say if earning is zero, very small or negative, then you have really nothing, very strict to use this ratio. You can't even use this ratio. It will not make sense at all. Of course, managers have the discretion to determine also the reported earnings. So the thing about earnings is that earnings can be, I would say, not manipulated. Manipulated is quite negative. It can be managed, right? Earnings management. Have any of you heard of earnings management? Yes, correct. So one of the way to recognize one of the ways for earning management is to recognize revenue too early, expenses too late. You're right. So in case I know some of you all are so accounting majors, earning management is one of the biggest topics in terms of research for accountancy students, as well as, like if you're doing your TCs, earning management is one of the biggest topics, right? So earnings can be managed quite easily, right? And of course, when we say easily, is of course in comparison with something, right? And the comparison is normally things like um, sales, right? Sales is very hard to manage. You can manage sales. You can, try to sell in advance, kind of like push the product into the market by oversupplying the market. You can do that, but it's a bit tougher as compared to earnings where you can, maybe not even revenue or expenses. You can even think about like depreciation, recognizing less depreciation, things like that. There's a bit more gray, right? So earnings, because everyone can recognize different kind of line item products, which will therefore impact the eventual earning number in the bottom line. That's why sometimes it can be less comparable with other companies. Comparability can be quite difficult with different growth rate accounting methods. As you know, there's IFRS, there is also US GAAP, and they have different accounting methods, right? For example, one of the big typical example is that in IFRS you no longer recognize operating leases, right? However, in your US GAAP, you still can have some leeway to recognize operating leases as expenses, right? So those differences can affect your earnings because if you recognize the expenses, of course, expenses will bring down your earnings. Okay, so now this is the part where we're going to compare it with what we can see in discounted cash flow. Okay, so why do we have this whole explanation here? So what's the purpose here? So the purpose here, right, and we'll see this in every ratios, is that we want to determine this idea of justified. I repeat again, we want to determine the idea of justified. So a justified trailing PE or justified PE, right? It means that what is the supposing PE, and so we can compare our company's PE with the justified PE to see that, okay, based on this comparison, then is this overvalued, undervalued, right? So in all the ratios, we're going to first determine the PE using the normal method, and then we determine the PE using the justified method. So let's determine how do we calculate the justified PE in this case. So we start off with the discounted cash flow model. We have the dividend discount model, right? Recall that dividend discount model, we are using a growing perpetuity. So we take D1 divided by R minus G. So it's a growing perpetuity. And then we know that D1 is equal to D naught times 1 plus G, right? So this is our dividend discount model for a growing perpetuity. Now, say, given that we have P naught here, we divide both sides by E naught, right? E naught. By doing so, we divide by E naught, then we put divide by E naught, meaning earnings in year zero, right? Divide by earnings by year zero. And this earnings in year zero, remember, if it's past earnings, we are getting the trailing PE, right? In the past, right? And so this will give us the formula for a trailing PE. And since we know that D naught divided by E naught equals to 1 minus B. What is B? Does anyone remember what's B? Retention ratio. You're right. You're right. Retention ratio. So D divided by E is how much dividends you distribute, right? How much dividends you distribute is 1 minus the retention ratio, right? I repeat again, D divided by E gives you how much dividends you distribute out of your earnings, right? And this is equals to 1 minus B, where B is the retention ratio. So 1 minus the retention ratio is how much money you have not retained, you have distributed out. Okay, so because of that, we can replace. So I'm just going to highlight what are we replacing. We are replacing this thing, right? D naught divided by E with this. So resultantly, we will have this here, and then we put in, I'm just going to use a different color. We put in this one here, we put in this one here, as given like this. And this formula here is your justified PE. Meaning what? If you have your retention ratio, you have your growth, you have your R, which is your return on equity or your cost of equity, then with these numbers, you can actually calculate what's your justified PE and compare it with your actual PE of the company using price divided by earnings. Okay. I want to pause here because this is important. Everyone understand the differences between justified and the actual PE because we're going to use this concept for all our relative valuation and try to understand the various way to formulate the justified number. Any questions? Any confusion? You need me to repeat what's the difference between justified and actual PE? No, we're good. Okay. Okay, that's good. Because I still remember when I was learning this relative valuation, I remember the professor went very fast in terms of just justify actual, and then at the end of the day, I was very confused. Like, why are we calculating so many different methods of PE, right? Why need justified? Why need the actual? So I hope we can see that justified is the another method of calculating PE, which is which is the supposing number, and then we use the actual one to compare it. So why do we use justified? Okay, so it's not why we use justified over market PE, is that we're going to compare the justified with the market PE. And I think when you say market PE means that you go look at the price of the stock in the market, what's the earnings in the market, and then you take price divided by earnings, compare it with justified. So the idea is that justified, basically in simple sense, right? Justified means what is the supposed PE. So you can do a comparison between the actual PE that you use, the market data, versus what is supposed for your PE. Hope this is clear. Okay. So remember, okay, so I'm just going to flip back here. So remember I say that for PE you can use a few things, right? We can use the historical, so you're just comparing the historical, compare it with other companies, which is the peers, and then its own fundamentals, and this is where you have the justified. This is where you have the justified number. So for all our ratios, we're going to compare the company's PE with the justified and show you how to do the justified. Because when you compare it with the peers, all these, you can plug the figures or historical, you can plug the figures from Refinitiv, S&P Capital IQ, right? But the justified one is where you might need to calculate yourself. Okay, so just now we were talking about trailing PE. Now let's do the justified leading PE. Leading meaning the earnings is forward-looking one, right? Forward-looking kind of earnings. Okay, we start off with the dividend discount model here. We know that the dividend paid in year one equals to the earnings in year one multiplied by what is not retained, right? What is not retained is 1 minus retention ratio B. Okay, so what are we going to substitute? We're going to substitute this D1 with this thing here, right? E1 times 1 minus B, which gives us this one. We're then going to, after having this, we're going to divide both sides by E1. So divide by the left side by E1, the right side, the E1 basically just cancel out here, right? That's why there's no more E1 already. There's no more E1 here. So what do we get? The justified leading PE is given by this, right? 1 minus B divided by R minus G. This is your justified forward or leading PE. Okay. For your PE, you also can use the FCFE model to calculate your justified PE ratio. And so, similarly for FCFE, we start off with FCFE, and this one of course is more your terminal value, right? Your FCFE in terminal sense, and then you have the growing perpetuity, treat as a growing perpetuity. And so with this, we divide by earnings per share, right? Meaning earnings, and this we divide by earnings. And so this gives you your justified PE based on FCFE. So some things to note about PE, right? And I would like to pull in the justified PE. So I'm just going to put here this one. So I'm going to just use this formulation, the trailing one. So it's 1 minus B, 1 plus G. So 1 minus B, 1 plus G, R minus G. Okay. So with this is PE. So based on this, we look at how does a high growth firm affect the PE ratio. So high growth means what? For this one, what does it mean? What is very big? G, you're right. G is very big. So if G is very big, means what? Your denominator is small, right? Small, and your numerator here is big, right? So because of that, you have higher PE ratio. Okay. Now let's go to the second one. All things equal, higher risk firm have lower PE. So for higher risk, what are we looking at here for higher risk? Yes, correct. R is big, right? So if R is big, your denominator will increase, right? Denominator increase cause your PE to decrease, lower PE. Okay. Next one, the firm has lower reinvestment needs. So reinvestment needs, what does this relate to? Yes, correct, tax. But then you're looking at D, right? The retention ratio. So lower reinvestment need means you need to retain less, right? Yeah, smaller B, correct? You're right, smaller B. So B is smaller. Okay, just want to take note, this B is smaller. So B smaller means this is, okay, let me just erase this one. Da, 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 da. Okay, is B, yeah. So B smaller means this one is bigger, right? If this is bigger, P is bigger. So these are just showing you how your P ratios might be affected by the various, factors R, G, and B. At the end of the day, what's important in last comment is sometimes it's very hard to ensure that everything is equal, right? So that you can compare PE. So that is just something to consider. So we have an example here for P ratio. Okay, so we do have the retention ratio as this, growth rate is 4%, required rate of return is 10%. So if your firm have a okay, so we are going to use the forward on forward PE. So on the based on forward PE, the justified forward PE ratio is this. So I'm just going to flip back to show you that it's actually this. All right. So this is the one we are using. 1 minus B, R minus G. Right? 1 minus B, R minus G. Okay. And then we just plug in the figures, right? 1 minus 0.36, 0.1 minus the G of 4%. And this gives us our justified forward PE. Okay, so if the firm's actual forward PE is higher than the justified, means it overvalued. So can you see now how we use the justified PE? So we are comparing the actual with the justified that we calculated for this. Any questions for this? No? All right. We have another example here. So FPL Group, a utility analyst forecast a long-term payout rate of 50%, the long-term growth rate of 5%, the required rate of return of 9%. Based on the forecast of fundamentals, what is the justified leading and trailing PE? Okay, so for the forward PE or leading PE, we use the same formula as the last example. So these are your growth rate, this is your payout, and your real return is 9%. And then for your trailing PE, we are using the other formula where I have 1 minus B. Okay, and then we get this. So this is a simple example. For PE, we also want to cover one more thing. For P ratio, normally it's quite common to determine the terminal value based on the PE ratio. And the idea of this is that there's some advantages because by determining the terminal value, we can determine the value of the stock. And so this PE is based on market data as well, right? So there is some value in determining terminal value using the PE ratios. Okay, so what's happening here? Let's have a look here. Okay, so we have a firm, the subject firm, required rate of return 11%. EPS forecast for 3 years is this, right? 2.5. Then we have the peer group, which is the one that we are going to compare with. We have a payout ratio of 0.4, mean earning return on equity, okay, and median PE. So all these are for the peer group. These are peer group. Okay. There's a small comment here. Assume that this is based on the industry EPS forecast of 3 years. So they calculate the PE, median PE using the earnings per share for 3 years. Okay, so based on this data, right, we know that earnings per share forecast for 3 years is $2.5. We multiply it by the kind of normal payout ratio, and so we get a dividends in year 3 of $1. And then we know that the amount of dividends payout is 0.4, means that B, we calculate B here, is 1 minus 0.4 is 0.6, right? What is retained is 0.6. And then we determine the G, right? Remember, G can be calculated using retention ratio, B times ROE. So we get G as this. So having determined your G, your dividends amount, we now can calculate your terminal value of your PE using your dividend discount model, right? And so this is just your growing perpetuity, right? So $1 times 1 plus G, where G is 0.048. Okay, you determine what is the value of your stock. And now we want to compare it with your peer group, right? So your peer group, you know that your peer group's PE is 9 and your earnings per share is 2.5. So in this sense, your peer group's value is actually 22.5. So the question is this stock overvalued or undervalued and why? How do you know where it's over or undervalued? So question, is it over or undervalued? Your subject firm or your firm that you are calculating, and how do you know that? You're right, undervalued, right? Because it's lower. So if you're going to compare this and this, your one that you calculated is much lower than your peer group. You're right, because lower PE. So all we have for PE. Before we move on, any questions for this PE ratio? So this is the most fundamental ratios. All right. So moving on, we have the PEG ratio. Okay. So instead of just looking at PE, we want to determine the PE per growth factor. So we divide the PE by the G factor. So why does this make sense? Let's kind of try to understand the concept behind this, right? Before we look in all the details, let's try to understand what's the meaning of this ratio. So the PEG ratio, first we assume that all firms within the sector should have similar growth rate and risk. So the strategy is to pick the lowest PE stock, will give, of course, the undervalued stock, and we want to buy undervalued stocks, right? So sometimes what we use is we need to compare the PE ratio with the growth rate, expected growth rate. Um, and then because maybe the company has different growth rate, we divide it by growth rate. So we can determine the PE per growth. That's one of the reasons why we calculate PEG ratio. However, there are some issues with this, of course. First of all, right? Um, P ratio less than their expected growth is generally viewed as undervalued, but there is actually no basis to believe. So these are the some issues they want to point out, right? There's really no basis to believe that the firm is undervalued just because the PE is less than expected growth. Is one of the issues. Relationship may be consistent with fairly value or undervalued stock if interest rate is high or if the firm is high risk. So what does this mean? So this one, right? What are we looking at when say interest rate and firm value is high? Anyone knows? Then divided by G again. So what does problem two means? It means the relationship may be consistent with a fairly value or even an overvalued firm if the interest rate is high. So when interest rate is high or firm has high risk, right, means what is affecting it? It is this thing here, R, right? So the thing is, if R is large, chances are your PE will be small. And because your P is small, you will say that it's undervalued. Everyone understand this? Do you need me to repeat this again? Maybe I'll just repeat one more time. If your interest rate or the firm risk is high, your R is big, right? If R is big, means your PE, which is given by this, your PE is small. If your PE is small, your firm, your will be considered undervalued, right? So this has an issue, right? There's some consistency issue. Next thing, interest rate decrease. If interest rate becomes smaller and smaller, means what? It means this thing becomes smaller and smaller, then fewer and fewer stock will emerge as undervalued, right? Because it means that your PE is larger and larger. So it's an issue as well. So ratio of PE to growth is used as a measure of relative value. Okay, so now PE to growth ratio. Now we formally learn how to calculate it. We just take PE divided by expected growth uh, in the earnings. And so we calculate it as the PE divided by expected earning growth, calculate the stock's PE per unit of expected growth. Um, so you make the PE of stocks with different growth comparables, different growth comparable. So like what I mentioned earlier, the idea is that different stocks are growing at different pace. So by dividing PE, by taking a PE divided by growth, we are actually determining um, we are able to compare stocks with as growing at different rates. So stocks with lower PEG is more attractive than stocks with higher PEG, right? So the same idea as PE, right? We want to determine the low PE because low PE means undervalued. So lower PEG similarly is more attractive. Um, So the thing is, whatever that affects PE ratio continues to affect PG ratio, right? So all the issues with PE ratio, for example, the earnings, I mean, earnings is easy to manipulate, to earning management, all these also affect PEG ratio. Um, Dividing PE by expected growth does not, okay, so this is also one issue, right? It does not naturally neutralize the effect of growth. So why it does not naturally neutralize it is because sometimes, or actually not sometimes, most of the time, the growth rate of the firm is not a linear model. It's not linear. It means that it is fairly complex to the extent it can be exponential growth. For example, a startup is exponential growth, or it can actually be maybe a slow growth, right? If it's a mature industry, slow growth. So it's not linearly like a triangle, linear, just go keep on going up like this. No, the ratio does not factor in difference in terms of risk, which is a very important component. So difference in risk means what? Your R, right? What if you're comparing firms with different R or return on equity? Then it might be very difficult to compare the right number. Okay, ratio does not account for difference in duration of growth. Oh, this is a very important part because what if you take the 10-year growth, 10-year G, 10-year growth rate versus 5-year growth rate? Of course, the 5-year growth rate maybe is larger than the 10-year growth rate, right? So because of that, if you're going to compare 5-year to 10-year, of course, you're comparing apples and oranges. You can't do that. But at the same time, if you're just comparing 5-year, why are you choosing 5-year compared to 10-year, right? So whenever you choose the duration of the growth rate factor, please consider. So this is also your assignment. Please consider your duration you want to hold your stock. So if your holding horizon is 10 years, then choose the 10-year growth factor. Okay. So really determine what is your time horizon of holding the stocks. If it's 10 year, choose the 10 year. Any questions? May I just pause for a short while? Okay, let's look at one more slide before we take a short break. So for PEG, high risk firm will trade with much lower PEG than a low risk company with the same growth. So let's understand this again, right? So I'm going to take my leading PE, 1 minus B, 1 plus G, R minus G. And for your PEG, you divide this by G, right? Okay, so what is happening here? A high risk company, high risk meaning what is affected here? For high risk, your R, right? Your R is going to be affected. Your R is going to be big or small, or in this case, your R is big, means your PE is small, right? And your PEG is small. Okay, so a high risk firm has much lower PEG than a low risk firm of the same growth rate. And so, what does it mean? It means that we are going to keep on saying that a high risk company is overvalued, and therefore we want to keep on buying high risk company, which might not be good because you are increasing the riskiness of your portfolio. Okay, that's one issue. The second issue is a company can obtain growth more efficiently by investing less in better return project will have higher PEG than a firm that grows at the same rate effectively. Okay, so what does it mean? It means that if the firm can invest in very efficient projects, the growth is very high, right? Your G is very high. If your G is growing very fast, means your PEG becomes what? If G is big, your PEG will be, yes, correct. It will be big, right? Because you have a few components here, right? Your G, and your G, right? So because of that, then the thing is, company might look cheap because they are investing in poor projects, meaning the PG is low because they are investing in poor projects. But actually, company that's investing in very efficient projects have a high PEG. Then this goes counterintuitive, right? Because remember, the idea of PEG is you want to look for low PEG. So it can be a bit difficult. Okay, the last point is company with very low or very high growth tend to have very high PG ratio. So this is very similar to this part here, right? If your company's growth is very high, then your PG will be very high. So PG does not neutralize the effect of growth because your PG has, let me just use a different color, have G here, and G here. So the three G, right, doesn't cancel out each other, even though at the end you try to divide by G. So this gives a lot of issue with the PEG ratio. Let's see. Okay, let's pause here. I think it's about time. Let's take a break. We'll come back in around 10 minutes. Okay. If you do have any questions, put them in the group chat and we'll come back to discuss. Hello, welcome. How's everyone doing? Stressed? Why? I'm also very stressed. Uh, ECA. Yes, the good thing about ECA is that at least it's very similar to your GBA. So what I noticed in previous semester is that if you guys work very hard together for your GBA, you come up with all the ratios, you really do a good job. What I noticed that most group that did very well for GPA, for your ECA, you do very well because you just use the same like models and stuff, but you just change the company, right? So I know the GPA is soon, you need to submit and that's all. If I mean there's still a bit of time, so I really encourage you to work hard together. It's it will help you in your ECA because of course 4 minds or 5 minds is better than 1 mind. So if you can work together in your GBA and do well, chances are your ECA will also do well. This is I notice this correlation, right? Oh yeah, of course you cannot, yeah, cannot use the same, but uh you can use a similar company in the industry, right? So that's why I encourage you not to use companies like Keppel or Samcorp, which is like very unique, right? There's only one in Singapore. Try to use a company like manufacturing company, maybe not well known, maybe I don't even know about it, but it's listed on a Singapore Stock Exchange. And so there's still so many manufacturing companies, right? And because of that, you can kind of use very similar discussion. But this only works, of course, if you really work very hard for your GPA. So let's say your GPA, you guys that decide. I mean, it's also strategy, right? It's all about strategy. If you decide that, let's say you want to focus on other courses, because I understand. So most of you are not just taking one module; you have other modules to focus on as well. So you need to strategize. If feel that maybe getting a B for this module is good enough, then you put in the B effort, right? Of course, if you feel that you need to get an A, then put in the A effort. So, strategize accordingly because I understand, many of you are working as well, and that you are taking multiple modules. So strategize accordingly. Um, Other countries is possible, yeah, because so comparables other countries. Why? Is because let's say you do SIA, there's no Singapore one, so other countries is possible. Video is for, yeah. So just read the question carefully and the assessment criteria for your presentation carefully as well. Cause for the presentation, if you notice your marks are located mostly for your posture, eye contact, these kind of things. So generally, please read the marking criteria for your presentation. Really, the focus is on your presentation skills, less about what you're talking about. So, for example, I did see in previous semesters people that score very well for your presentation, but maybe didn't score so well for your written ECA component, and the vice versa, right? People that score not so well for a presentation, but score very well for ECA. So please read the marking criteria very carefully. I see a question for ECA report. Do we need to submit the proposal report and not usually the way we submit? Okay. So for ECA, there's a question I think directly to me. The question I'll just read out so for everyone's benefits. For ECA report is that we need to submit as a proposal report and not the usual way we submit GBA or TMA assignment. So I think what you're asking is, should you submit as a full report or should we answer question by question? So I would say both methods are possible, but the important thing is this, that you need to have a flow in terms of your report. So if you want to answer question by question, this is good as well because the marker and like what sometimes I might not be a marker, so it really depends. I'm not sure whether I'll be marking your ECA, so it really depends on the school. But let's say the marker knows where you're answering question by question, it might help him or her give you the marks. But at the same time, if it's all lumped together, might be more difficult. But then at the end of the day, the flow of things will be very important as well. Okay, let me see. So short answer to your question, flow is more important than whether is it question by question or not. Is it okay to show outdoor background? Yes, outdoor background is okay. Yeah, you cannot use Zoom to record. You need to, I believe, use the platform. You got to check with the school did give some criteria for you how to record. Uh, Also, I encourage you. This is really like free marks. For your presentation, please dress up. So what I noticed in previous semester, like what I mentioned, I might not be the marker for your ECA. So generally, I noticed that markers will give higher marks if you dress up for your presentation. So this is a big tip. So please dress up because it's treat it as like a real presentation to live audience. So I encourage you to dress up because the marker, what I noticed is typically give more marks if you do dress up and take it seriously. I hope all those tips are useful. Yeah. Uh, what was that higher? What's that? What's higher view? Is that a new one? Yeah. Oh, okay. Online, yes, like an online interview. Yes, yes, you're right. So treat it like online interview. I remember there's is it last semester or semester back, there was this fellow that dressed up with like suit and tie. I think he got like full marks for his ECA. Of course, dressing is one of them. You need to make sure eye contact, these kind of things, right? But if you dress up ready, you show that you put in effort, markers tend to give you more marks. Yes. So as you know, I think if you decide not to submit your ECA this semester, you can retake it next semester as a retake student. And then you do not need to do any part of your continuous assessment or OCAS. You just need to do your ECA. That's right. Yeah, so I know some of you are also doing your internships and working. So, use what you have learned in your internships or working in your presentation. Because again, I want to highlight that for a presentation, we are not looking at content. We are looking at all the typical presentation cues like eye contact, speed of your presentation, how you speak, this kind of thing. Need to show whole body? No, you do not need to show whole body. It can be half body. Um, you can stand up, like treat it as a presentation. You can, yeah. Yes, so generally, if it's a one big video presentation, you will be awarded more marks than, I know some people like to do this thing where you tag the video inside your slides. That is possible too, but generally, I think, because it's not like a presentation, right? You're just recording and then you tag it into a slide. I think depending on the marker, they might award us lesser marks. The better looking no, okay, so it's not about whether you look handsome or look pretty. It's about just like an interview, right? Put in effort, and then the interviewer like, oh, okay, you you are putting effort, and then they'll accept you for the job. Okay. Okay, let's go back to this. We can answer more questions in a bit, but let's go back to the topic on hand. Okay. So PEG. Prior to um the break, we're talking about PEG. So let's look at this company, right? We have company A, PE of 20, company B, PE of 15, right? Company A is growing at 15%, company B is growing at 10%. Okay, so different PE, different growth rate. So let's calculate the uh, uh, um, PAG. So the question is, which company is more expensive? Does higher growth of company A compensates the investor for higher valuation of A. So let's calculate PEG, right? So using PEG ratio, um, company A is 20 divided by 15, company B is 15 divided by 10, right? So these are your growth of B. One. So while PE of A is actually higher, so on pure PE rate basis, PE is higher for A. On group basis, actually PEG for B is higher, right? So you notice that it really depends on how you evaluate PE or PEG because if there's different growth, we need to consider the growth as well. So we have another example here. Again, it's similar to what we saw in PE. We have the subject firm, 5 years PE growth of 8%, consensus of uh, EPS of 4.5, stock price of 2.28, sorry. We have the peer group. The peer group has a median PE of 9 and median PEG of 1.6. So calculate the forward PE, PEG, and intrinsic value of the stock, right? So intrinsic value, what is this? Anyone recall? What's the intrinsic value? What is the thing that we're using? Yeah, discounted cash flow, which meaning that's the terminal value, right? I.e. your perpetuity, right? Your dividend or something. Yeah, discounted cash flow. Yeah, dividend growth model. Yeah, right. Okay. Okay. So let's look at what's happening here. Okay. So first one is PE ratio. So PE, we just take price divided by earnings. So where's the price? Let me just highlight to you. Where's the price? Da, da, da. And what's your earning? Earning is this, right? 4.1. Get this. So notice that this is the forward PE. Why forward PE? Because we are using the earnings forecast. Earnings forecast here. Okay, is lower than the P. Okay, so in terms of the peer group, your median PE is 9, and what you have calculated is 6.2, meaning it's undervalued. Your forward PE is FY plus 1. Where are you looking at? Yes, it's FY plus 1 because your earnings is forecast, right? So it's forward looking. Is that what you're asking? Yeah, it's forward looking. Forecast for 5 years. Uh, yeah, okay. So it really depends. Remember, we had the PE calculation earlier. Let me just, it's all the way back here. Remember this one? So what PE are you interested in, right? That's the part where PE becomes very complex because there's so many variations. Are we interested in the next 4 quarter? Are we interested in the next 5 years, current year, current fiscal, next 12 months? So there are many ways to do PE, right? So you have a good question. It can be plus 5 year, it can be plus 1 year. So in case you're taking the please know what you're taking from Refinitiv or S&P Capital IQ and use the appropriate one. So in this case, it's just plus 1 or not really, it's a bit silent, so assuming plus 1, but it can be plus 5 as well. PEG, we divide by the growth rate. So growth rate is where? Growth is 8%. This is 5 year. So in 5 year growth, that means the forward PE is likely 5 years as well. I mean, this question is a bit silent, but likely it has to be apple to apple, right? So PE likely to be forward 5 years divided by the G of 5 years. Okay. Is lower than the what is the peer group PEG of 1.6 is lower than the PEG of 1.6 indicate undervaluation and is considered PEG under one as undervalued. Okay. Last but not least, intrinsic value. Okay, so this one is slightly different. We're not using a terminal value. So sorry, my mistake here. Generally, yes, we use terminal value, but for this case, intrinsic case, we basically take the median PE. So we are taking this median PE multiplied by our earnings, right? What is our earnings? Okay. And this gives us an intrinsic value. Okay, that's all we have for PEG. Let's move on to the next ratio, which is price to book value ratio. So the price to book value, now we are comparing the market price with the book value, which is what we find in a balance sheet. Okay, so let's think about this, right? Before we, again, as usual, I always like to do this, where we think about the broad idea of this ratio first before we go into the details. Right? So the idea is that this we have book value, right? So book value is what is recorded in the books. And then we have the price. So we're actually trying to do a comparison whether the price of the company is so much bigger than what is the initial value that is recorded in the books, right? And when we think about books, we are looking at the equity, right? We are looking at equity. This one to show is equity. So meaning what? We are comparing what is the value of the equity in the market versus the value of equity in the books. So of course, when the shareholder inject the money, is the that value book value in the books, right? Your balance sheet. So then you do the comparison like this, right? What is in the market with versus what's in the books, and that's where you do the comparison. Okay, and so that's the idea of it, is that you want to see how much more or less the market is valuing the equity compared to what's initially invested. Okay, I repeat again. For price to book value, we are comparing what's the difference in price, whether higher or lower, compared to what's initially invested by the shareholders. So this is what I've mentioned. The book value per share is what is fine static in the balance sheet. Of course, the price is market value of your equity, represents the investment of common shareholder make on a per share basis. So what this means is that how much more the market is making compared to what was initially invested by the shareholders. So price is what the investor is going to pay at that point in time. So price is, of course, this is market value, right? How much is doing at this point in time versus the book value is how much the investor initially paid for it in the past, right? The good thing about this ratio is generally positive because your book value is always positive. It's more stable than your earnings per share, right? Earnings keep on changing, and it can be, like we say, earning management, appropriate for firms that will be terminated. So, let's say the firm is going to stop existing in 5 years' time, right? It's just, let's say, a project company that's going to stop existing. So, if in such a case when the company is going to stop existing, then the firm will terminate. So we will basically get back all our book value, right, that we initially invested. So this ratio becomes very appropriate because we want to see what's the difference now when it finally stop existing. What's the difference between the market value of the equity versus the initial book value of the equity that we invested in this project company. Weaknesses, it does not recognize non-physical asset. Okay, this is like your intangibles, human capital, can be misleading due to accounting practices. So this one reason why is because of increasingly, I know some of your accounting students, you have your OCI. So OCI is your other comprehensive income. And your other comprehensive income basically impacts your what? And then anyone knows? OCI impacts what and then what? So this is important because this one, it will help you do your valuation. So yeah, you're right. So the figure is below the bottom line. So you're right, and you are right. So impacts the equity. So yes, it impacts equity, but it does not impact your bottom line because it's below the bottom line. Okay, let me repeat again. Both of you are right. So OCI figures impact the equity number, but it does not impact the bottom line because it's below the bottom line. And normally, in your analysis of earnings, you look at bottom line, meaning you look at net income and that's all. You don't even consider OCI. But in your value of equity, it will always consider, or most of the time, you'll consider your OCI inside, right? So there are some accounting practices that can be this very misleading, right? That means your earnings is not reflecting your OCI, but your equity reflects your OCI. Okay, record asset is at historical cost makes it difficult to compare firms with different ages. Yeah, because your book value is historical cost. So yeah. So price book value ratio is a ratio of market value of equity to so they see market value of equity divided by book value of equity. So it measures the shareholder equity on the balance sheet. Okay. So now, because your equity on balance sheet can be a bit confusing how to calculate. So let's show you how to calculate the basic form, right? So I know some of you already started looking at more complex companies that has many line items, and I think some of you also reach out to me like, oh, how do you calculate working capital, right? Because it's so complicated. So I want to highlight there are many ways to calculate working capital, as well as there are many different nowadays different equity, right? There's common shareholder, there's preferred shareholder, there is class A, class B, class C kind of shareholder. So there are many ways. That is I would say, the difficulty in terms of valuation because there are many different types of ways to do it. But at the same time, is where it becomes an ECA, right? Why is it ECA? Because it requires you to do your own research, try to learn a bit more on yourself by yourself. How do you handle this kind of class A, class B, class C shares? Okay, but in the most basic form, right? In the most basic form, or what we're trying to teach you here is this: a common shareholder equity is basically your total shareholder equity minus your total value of equity that are senior to your common stocks. So what it means senior? Meaning that there are things like your preferred stock which are being removed. Okay, I repeat, that should be removed when calculating common shareholder equity. So your book value per share, now, once you determine your common shareholder equity, you take book value. The book value per share is your common shareholder equity divided by number of common share outstanding. And repeat again, this is common share only, so it's not your preferred share. So just be very careful what is considered. And this is just a basic form. Again, I want to say that nowadays, if you look at very complex balance sheet, there are many kinds of um, adjustments you have to do, right? So this is just a very simple adjustment that you need to remove any preferred stocks, preferred dividends, etc. But there are many other things you might need to remove, and part of the I guess whether it's GBA or the ECA is about researching on these things and trying to figure things out. Okay. So again, similar to what we did in PE, we are going to do the justified uh, BP or price to book value ratio using starting with our DDM again, or this discounted dividend discount model. Okay. With a dividend discount model, which gives us your what's this? Your growing perpetuity. We know that for D1, basically is your amount of dividends, right? It means that is your amount of earnings multiplied by 1 minus D, which is your retention ratio. So what you did not retain is being distributed out as dividends, right? So your dividends in D1 equals to earnings in 1 times 1 minus B. Okay. And then what is earnings? Earnings can be given by your book value multiplied by return on equity, right? So how much what's your book value of equity multiplied by return on the equity gives you what is your earnings of your equity, right? And because of that, what can we do here? I'm just going to highlight here what are we going to consume. We're going to consume meaning we're going to use this 1 minus b. And instead of E1, we're going to use this one, right? Book value B naught 0 times earnings ROE. So based on this is our numerator here. So your instead of B, we have changed it to B V naught times ROE times 1 minus B. And then the bottom is the same, right? R minus 3. Now, we're going to divide it by B naught, sorry, B naught, BV naught. So we get the book value. By doing so, we have done what? We have cancelled out B naught here, right? So that's why there's B naught is gone. Okay. And then the next step, I just multiply in here, like do a bunny hop in, which gives you ROE minus ROE times B. So we know that ROE times B gives you, this one is your sustainable growth rate, right? Which is G, your sustainable growth rate that we have learned in lecture, I think lecture 2, I think. And so with that, we have now determined this, which is our justified price to book value ratio. And if we look here, right, in simple sense, if we do some estimation, it means what? Actually, only these two terms here is important, ROE and R. If ROE is more than R, your shareholder will be willing to pay more book value. Right, book value is more than one because it is an estimation, right? Because both is minus G, but then if ROE is more than R, means that your book price to book value will be much chances higher than one. Okay. Regarding this, we are going to use the justified price to book value with our residual income model. So how do we start off? So we have, okay, so what's happening here? ROE minus, okay, so how do we, wrong one, how do we get this first, right? How do we get this? So I'm just going to show you, let's say I combine this into one equation. So it's R minus G to one fraction, which gives you R minus G plus ROE minus R, right? And then what do we have here? We have R and R cancel out, which is give us ROE minus G, there are R minus G, right? This is our resultant. Do you notice that this ROE minus G divided by R minus G is exactly what we are talking about here? ROE minus G divided by R minus G, right? So basically, this formulation now that we have it here looks very similar to this residual income model. Why? If I was to do this, if I was to multiply B naught into here, do you see that B naught multiplied by this and then multiplied by this gives you this, right? B naught and then B naught here. Can you see that this formulation, I'm just going to use this color now, is your residual income model. So I just showed you how the price to book value ratio can be derived from the residual income model, which allows you to determine the justified price to book value ratio based on residual income model. Any questions for this? Okay. Okay, so we have an example here. quite simple in the sense, okay, we have our ROE of this business given at 12%, required rate of return is 10%, expected growth is 7%. Then the justified price to book value will be based on, we just take ROE minus the growth, divide by return 10% minus the 7%, and then this is our price to book value. Justified price to book value. So that's all we have for price to book value. Now, for price to book value, notice something. We are only focusing on equity, right? We're looking at equity only. Okay. Now, what is this Tobin Q? So Tobin Q, instead of focusing on equity, we're just looking at the firm value. So Tobin Q is the same as price to book value, but instead of focusing on equity only, it is focusing on firm. What's the value of the firm? So this is very similar to your FCFF, FCFE, right? FCFE is only equity, FCFF is firm. Okay. So in this sense, Tobin Q is market value of the firm, right? Divided by your market value of your assets. Market value of assets can be considered the replacement cost of assets. So both ways are quite similar, but it depends on how we determine market value, right? Market value can be determined by what's the cost of replacement, or it can be determined by how much being sold in the market now, right? And those are slightly different. So this is the interesting thing about replacement cost. Replacement cost might not be equals to the market value, right? Sometimes replacing something might cost more than the sales item, the market value of that item. But in any case, most of the time we use them as good proxies. So replacement cost is a proxy for market value, but not necessarily. Just want to highlight. So in any case, if Tobin Q is more than 1, it's overvalued, right? And then if it's less than 1, undervalued. Of course, we want undervalued stock. Just to highlight to you, the difference between price to book value and Tobin Q basically just relates to how Tobin Q is just using the firm, while price to book value is just focusing on equity. Generally, Tobin Q is quite popular in the sense that it's used for M&A activities because you want to value the firm value. And companies that have few less than 1 are likely for takeover because it's undervalued, right? So it'll be likely to can move up. We have one more, price to sales ratio. Okay, so price to sales ratio, we want to take the a price, which is the market value of the equity, divided by the sales, which is your total revenue. So the price to sales ratio a bit is almost like your price to earnings, right? But your price to sales is good in the sense your remember your earnings can be negative, your sales will never be negative, right? So sometimes if your earnings is negative, you use your price to sales instead. And of course, sales figures are hard to manipulate or to be managed as well, because sales is sales, right? You need to make a sale in order for you to record a sale. Of course, there are ways to also manage your sales, less options compared to earnings. So in the same sense, we like to determine the justified price to sales ratio. So our justified price to sales is against of your DDM, discounted dividend model. All right. We know that we determine the D0 version, where D0 is D1 equals to D0 times 1 plus G. D0, we also know that the amount of dividend that is being distributed equals to your earnings times 1 minus retention ratio, what is not being retained. And then the thing is, we know E E naught equals to sales S naught times net profit margin, right? So your sales times net profit margin gives you what's your earnings, right? Because your net profit margin is basically net profit margin is what? Is your net profit divided by sales, right? So if you multiply it by sales, cancel gives you net profit, and net profit is what? Your net profit is your earnings. Okay. So with this in mind, I'm just going to highlight to you what I'm going to pick up. I'm going to pick this sales and net profit margin, and I'm going to pick this one plus 1 minus B. Okay. And because I am using your DDM, I need to pick up this also, 1 plus G, right? Because these are the figures I'm using here, here, and here, right? So these are the three things I need to pick up, 1, 2, and 3. So if I pick up all these three, I have this on the numerator, divide both sides by sales price, and because I can divide by sales, this sales gets tracked off, but disappeared. And so what do I get here? I can convert your net profit margin, which is to this, right? Net profit margin is net profit divided by sales, which is earnings divided by sales, which is given here, earnings divided by sales. And then your whole chunk of thing here. And so the key determining factor of price to sales ratio is therefore your net profit margin. Can you see that your B and your G, yes, it has some effect, right? Your R also has some effect, but your main thing that's going to make a big change would be your this part here. E naught divided by S naught, which is your profit margin. Any questions? So this is your justified price to sales ratio. So price to sales ratio, PS, advantages, sales is less easy to manipulate, like what we talk about. However, revenue can be recognized differently. Anyone has a comment on this? Anyone know about this different recognition for revenue? And how can it be recognized differently? Anyone knows? Anyone want to comment on this? Includes subsidiary? No, not. What do you mean? Okay, what do you mean? Include subsidiary? What are you trying to say on this one? More subsidiary, more revenue. I guess yes. Um, because subsidiaries are consolidated, right? So in a sense, you are right. More subsidiaries, more revenue. However, I just want you to be careful because if a subsidiary um is dormant, it's not making has zero movement, then maybe there's no more. There's not really more revenue, right? Just want you to be careful about this. But what I was trying to think about is this revenue recognition, right? Different accounting standards. Okay, yes, but specifically what? Do you have a specific accruals and prepayment? Yes, there might be accruals and prepayment because revenues are recognized when it's being earned rather than when it's being received, right? So you're right, accruals and prepayment. Also, one more thing I want to highlight to you is, have anyone done a analysis of construction companies? Different definition of when revenue is recognized. You're right. Yeah. Okay. So, oh, you make sense. So I think you have saw contract. Yes, work in progress. You're right. So revenues are recognized for construction or even shipbuilding, right? So just now I mentioned ALS Marine, shipbuilding companies generally recognize because building a ship is very big, right? Or building a real estate or constructing real estate is super big. So they do recognize based on the contract on milestone basis. This is probably something you heard about milestone recognition, revenue recognition. Yeah, correct. So there can be if it's equipment, it can there's a when there's transfer ownership, that's where you recognize the revenue or milestone basis or what does POC means? Yeah, percentage of completion method. You're right. Yeah, okay. I'm just not sure what's that abbreviation. Yes, you're right. POC. So how much of the project you have completed, you recognize the revenue, right? Even though you might have received the full lump sum of money, you cannot recognize revenue until a certain completion. So you need to defer your revenue until you have completed 50%, then you recognize, let's say, 40% of your revenue, something like this, right? You're right. POC method. So revenue recognition can be different. At the same time, right? Because let's say if it's a POC, something new I learned, this abbreviation or percentage of completion, uh, this is very subjective. All right, how much you recognize? How do you measure 50% and not 55%? Right. So sometimes I wouldn't say people would recognize zero, let's say 10% completed building and recognize as 100% completed. That one, of course, you can't run. But let's say if it's a 55% versus 65%, how do you know there's a 10% increment of your completion? Right? The kind is very subjective. So you're right. There's a bit of recognition, gray area is aspect. And so for construction company or companies that does large scale uh, asset management or fixed asset construction, then it becomes what? It becomes uh, a bit tricky. Okay, it becomes a bit tricky to determine when you recognize the revenue. Sales are also always positive, less volatile than earnings. We talk about this. Empirical evidence suggests, price to sales is significantly related to long-term stock returns. Uh, PS is also appropriate for valuing stocks for matured, cyclical, and zero income companies. Yeah, so if there's no earnings, you also can use price to sales ratio. Weakness, high sales does not mean positive EPS or cash flow. As you know that even though you have very high sales, you can go bankrupt, right? In case you are using too much expenses, you can go bankrupt. So it doesn't equate to a positive cash flow. PS ratio does not reflect the difference in cost structure across the company as well, right? Because you're using price and sales. It does not reflect, how much percentage is buyer using uh, in terms of debt, how much is equity. Okay. So we do have a question here. Uh, I think it's probably one of the last example, but let's look at this, right? We have a lot of options here. So this is one of the best example because it incorporate all the ratios that we have learned about. So we are given stock price, EPS, dividend per share, book value of equity per share, sales per share, ROE, and required return on the stock. We want to call it actual, so it's actual, I highlight in yellow. Price to earnings, price to book, price to sales, right? So the actual quite simple, right? Quite simple in the sense why? Because price to earnings. Okay, where's our price? Where's our price? What's the earnings? 50 divided by 2. Price to book. Where's our book value? 6.25, right? So I'm just going to flip over to show you, right? All these are your numbers. 2. Then last but not least, your price to sales. What is your sales figure? 15, right? So 15, where's your 15? Here, 15. And of course, $50 is all your price. $50 is all your price that is standard. Okay. So the actual one is relatively simple. But where the a bit more tricky part is your justified number. So your justified number, let's see what formula do we have to use. Okay, so first of all, we need to determine a few things, right? Remember your justified one. I mean, we just go through it, right? So the justified one kind of need to use a few things, right? We need to use our retention ratio. We need to determine our G, and that's the two things that we count. So, how do we first of all determine our dividend payout? We take how much dividend is being paid, right? How much dividend is being paid divided by your earnings, right? So I'm just going to flip over to show you how much dividend is being paid and what's the earnings is $2. So this is our dividends per share. Okay. Sorry, not dividends, your payout ratio. I mean, from the payout ratio, we can determine what's your retention ratio, which is given this. And with your retention ratio, you can multiply your retention ratio by your ROE, right? ROE to give you your sustainable growth rate. So basically, your 0.4 and 9% are your important number. After doing that, we can now determine our justified. What justified do we need to determine? Justified price to earning, price to book, and price to sales. So recall our justified price to earnings, and this is your trailing version, not your forward-looking one, your trailing version. It is what? It is 1 minus B plus, times 1 plus G divided by R minus G. Basically, you just plug in all the figures and you get this. Your price to book, if you refer to the previous slides, is your ROE minus G, R minus G, right? Remember that we mentioned that for your price to book, your ROE and your R is the factor that really changes your number, which gives you this. Last but not least, your price to sales, where we are actually looking at this part that actually is the determining factor, which is your net profit margin. So with this, you can calculate your justified. And then after doing your justified already, we now can compare, right? So remember to say we shouldn't just use one ratio, we should use multiple ratios. And in fact, you can even use other ratios that are not taught in this module here, right? So what we have determined here, we have determined that for all cases, your actual is more than your justified, which means what? The stock is overvalued. So let me pause here because this is a very good example. Do we have any questions, any clarifications you'd like to check regarding this question? Because it's a very good comprehensive example of what we have covered today. No? It is quite clear. And you notice it's not that complicated, right? In fact, relative valuation is quite simple because it's just using ratios, but at the same time, it is very simple to make mistake as well. So, when you pick the figures from your balance sheet, from your P&L statement, please just be very careful to choose the right stuff, right? Because it's easy to make kind of mistakes. Okay. So, actually, for lecture 6, that's all we have today. Now, I know we still have about an hour to just use the time, of course, not the full hour. If we have any questions that I'd like to raise in terms of just general like valuation, things that you have encountered, and then you want to clarify, because it might be easier to just clarify whether is it to unmute yourself or maybe even your friends can help. those that are in the class today. So do you have any questions, regarding valuation in general? So what we have covered so far, lecture 1, 2, 3, 4, and 6 will be good enough for you to complete your ECA. And I know you have also other modules, so you can kickstart your ECA earlier and get it over and done with. You submit it, and then you can focus on other modules. So, do you have any questions that I could ask? Let's see. Good question. Must do justified version of the ratio for ECA. Yes. Okay. I would say that it's better that you do the justified one because it's something that we taught you how to do. Uh, Rather than you can compare the actual using Refinitiv and then do a few justified one for you to do a comparison. Yeah, I'll encourage you to do that. Uh, I think as we were talking about along the today's discussion, we mentioned a couple of things that is important. For example, the presentation. We will talk about presentation. For the PowerPoint slides, I want to highlight to you that for PowerPoint slides, even for me, I'm not an expert at PowerPoint, uh, but please read how the marks are distributed for PowerPoint. Generally, it is being distributed in terms of how well it's being formatted, this kind of things, right? So for presentation, it's about more body language, about speaking, eye contact, this kind of thing. So it's really about presentation. For PowerPoint, it's more like the layout, the format. You can look at the assessment criteria. So try to focus on that. If you want to really score for PowerPoint and your presentation, those can really help you pull up your marks. If you use Refinitiv to do justified, yes, you can use Refinitiv to do justified as well. Yeah, you can. Yes, it's easier to find your comparables on market intelligence too. In fact, nowadays, to be fair, right? Once you go out to the working world, and if you are equity analyst, no one will ask you to physically calculate the numbers like this because everyone will use their own models. It's just of course good to have a good foundation, but having understood what we covered today, you can use market intelligence tools like Refinitiv to help you explain the various differences in terms of actual versus justified. Yeah. So yes, you can use Refinitiv to help you. That's why I would say, okay, maybe this is like probably a broken record. So I want to say that in your ECA, 100% of your would use Refinitiv or S&P Capital IQ or Bloomberg, basically one of either of these platform or set to do your analysis. So I hope no one would use Yahoo Finance. Okay, I repeat again. I hope no one will use Yahoo Finance because if you're going to use Yahoo Finance, you'll be thoroughly marked down by the markers, right? So, like I mentioned, your ECA might not be marked by me, and for whatever reason, other classes, maybe the professor has forced them to use Refinitiv and all those platforms, and therefore all the students use that. So, if you're going to use Yahoo Finance for whatever reason, and then that professor is the one marking, um, he might just really mark you down. So because this is a more of a level 3 module, you really need to use those platforms and not Yahoo Finance. If you are doing, like, let's say, the basic Finance 101, Yahoo Finance, okay, but this one you really cannot. I really want to give you this big tip, or not really a tip, but it's really something that I keep on stressing to you, that you must use market intelligence tools. Before 10, yes. So it will be out before 10. Let me just check. Not sure whether can be we can discuss. Yeah, it should be. Uh, might not. Okay, so I'll try to put as much comments as possible because I might not be able to release the grades depending on the school before your last lesson, right? So it might be a bit tough to release before last lesson. Well, I mean, uh, whether submit ECA or next retake. I mean, try not to retake. I mean, if you feel that you have been understanding the content, I'm sure that you can do well for your ECA, right? So I also want to highlight to you also, because if you notice, I think most of you are year two, year three students, you probably notice compared to year one, there has been a lot of changes in terms of assessments, right? So yes, maybe you want to do a retake, but I dare not say that the assessments will be the same, right? We might change, the school might want to change the assessment methods, right? So if you notice there has been quite a bit of changes in the recent couple of semesters. So in case you are thinking of retaking, just do consider that aspect because if the assessment criteria change, it does not reduce your work. It's like, of course, retaking the whole semester, a whole module again. Yeah, yeah, it's something that you notice that there has been quite a bit of changes in terms of assessments for the modules. If you notice, yeah, there's no more TNA, it becomes class quiz and these kind of things. Yeah. Any other questions? We can take this time to clarify any doubts. Of course, I think with some of you already know, I reply email quite fast. So in case you have no questions or you don't want to ask it in class, you can always drop me an email. So at the end of this, we see that there are some questions. These are not so relevant for your finals, but these I do put these questions because for I know some of you are taking the CFA. So for those who are pursuing the CFA, these questions are very useful because these are actually CFA related questions, right? So I've selected them and provided you the workout solutions as well. So if you're taking the CFA, do have a look at these questions. Now, of course, for those who are pursuing like finance, I encourage you to take CFA as well while you're doing your undergraduate because you are learning the content of the CFA, so it's a lot easier compared to learning by yourself when you are working. Any other questions regarding valuation? Yes, you can email me, definitely. Yeah. Okay, last call before we call it a earlier night because I know that also many of you are still completing your GBA. So in case you want to have a group meeting after this to discuss your GBA, please do so. But that's really all I have for you today. Uh, final question, last call. If not, let me just pause the recording.